Hey guys, Donnie here at DeMar Group, eXp Realty, Memphis, Tennessee, and today we're going to talk about a super hot topic right now that keeps coming up, adjustable rate mortgages. So stay tuned, let's talk real estate. I was doing some research here on the computer because it just keeps coming up. I'm starting to see it. I haven't heard the term adjustable rate mortgages in goodness gracious, 3 or 4 years probably, because interest rates have been so low for so long, we haven't had to worry about them. Nobody really had a need for them. So now it's starting to pop up. People on Facebook, social media, in articles, all that kind of stuff. All of a sudden they're talking about adjustable rate mortgages. Should you use them? And I've got some information here for you about adjustable rate mortgages. I've got some opinions here for you, and we're going to go over what I think about them. What I'd love for you to do, though, obviously jump down in the comments. Let us know if you are aware of what an adjustable rate mortgage is and what you think about them. So I'd love to see what you all think. As always, we love feedback from the viewers out there. Don't forget to go ahead and like and subscribe to the video. Hit the bell so that you always get notified of our new videos as well. So what is an adjustable rate mortgage? Basically, it is a mortgage rate that can change over time. Typically, they are tied to some kind of standard. The most common one I probably see is the LIBOR, and I'm not going to tell you what that stands for because you're not going to remember it, because I don't remember it unless I look it up. Just know that it is a interest rate index that changes over time, and if you have an adjustable rate mortgage that is tied to that index, when that index goes up over time, your interest rate is going to go up with it. If that index goes down over time, your interest rate is going to go down with it, which could be a great thing. Now, I got to ask you a question. Which way do you think interest rates are headed today? It's the end of May 2022. We've had multiple Fed prime increases in the last couple of months. And my understanding is we have multiple prime rate increases from the Fed coming up in the next couple of months. I'm going to bet that those adjustable rate mortgages are going to be adjusting up over time. So just know that it can change over time. Now, compare that to a fixed interest rate mortgage, which is what most people get, which means your rate is locked in. So if you lock in at a 5% today, it may not look as good because at adjustable rate, you might can get it as a 4, but that 5% is going to last you for the next 30 years or however long you have that mortgage. So if rates go to 9, 10%, you're still only paying 5. And that's a pretty good deal to have a little bit of security, okay? Now, what is wrong with an adjustable rate mortgage? And I'm not saying they're always bad. We might even talk about some times when you could use an adjustable rate mortgage. But what is wrong with them? So I took the liberty of using calculator.net and running a couple numbers for you just so that you can see what could happen. If you got a loan of $300,000 today into May 2022, a 4% interest rate, it's adjustable, that's the rate. Your payment, principal and interest only, according to on a 30-year loan, according to calculator.net, would be $432 a month and some change. Well, that's at 4%. Now, if you compare that to a fixed rate mortgage that you might get today at 5%, which would be $1,610 a month, principal and interest only, about $180 difference. Now, you might be tempted. You might say, hey, this adjustable rate mortgage is a point lower. I can save $180 a month. That's almost $2,000 a year. This is a good deal. I'm saving some money. Well, just remember next year your rate might be 5%. So then you only save that money for 1 year. Now, what happens if a few months later it goes to 6% because you had an adjustable rate mortgage instead of a fixed? Well, now your payment jumps to $1,798 a month. So now you're almost $300 more per month than you were before. Now, what if you bought as much house as you could afford, which a lot of people do? You already maxed out. What's it going to look like 2 years from now when you're paying $300 more than you were originally planning to pay and you were already maxed out? And on top of that, which direction do we think property taxes are going for most of us? Which direction, with the cost of lumber and the cost of labor right now, which direction do we think property insurance is going to go over the next couple of years? So between insurance on your home, or increases on your homeowner's insurance and increases on your property tax and an adjustable rate mortgage, you could be adding hundreds of dollars every month here in just 1 or 2 short years that you're now tied to for the next 28 years of paying those higher payments. What if it goes from 4 to 7? 7 is still traditionally a pretty low rate, believe it or not. When I bought my first house, I think I paid about 7% 20 years ago. From 4 to 7, you go from that 1,400 number I gave you earlier to 1,995. A $500, $560 or so increase in monthly payment. That's a huge part of a lot of people's income. And then when you add inflation on top of that for your groceries and gas and everything else, you add increasing property tax, you add increasing property insurance, you can see within 2 or 3 years, your housing costs, instead of it being fixed and being locked in, could go up $600, $700, $800 a month. So be smart about that. Whereas if you would have had that fixed rate mortgage, it was locked in, the interest rate changed, the principal and interest part of the payment never changed. Your taxes may still change, but the principal and interest would. To me, if it's my primary residence and I'm going to be there for a long time, I'm going to get a fixed rate mortgage. Now let's talk about when you might use an adjustable rate mortgage. I'd love to hear if any of you all have ever used an adjustable rate mortgage, maybe for an investment property or something like that. Throw it in the comments. Let us hear if you've ever used one and it came out great for you, or if you've used one and it came out bad for you because you might help somebody else out too. So if I were going to buy an investment property and I had a plan to refinance it after I renovated it and fixed it up, so I knew I was going to have my first loan maybe for 3 to 6 months while I was having work done, and then I was going to refinance it into a fixed rate at that time, or I was going to resell it at that time. Could it maybe be beneficial to have that 1% lower interest rate? It could. Keep in mind though, that if it saves you $180 a month like we talked about, and oftentimes investment properties are a lot less than that, for 3 months, you save $600. Hey, if I'm trying to make money running a business, every dime might count, right? I get it. However, what happens if you get surprised and all of a sudden you have to hold that property longer than you thought you were going to have to hold it? Well, now that $600 that you saved, if it ends up being long-term, that rate could go up. But there's some risk involved in that strategy. Investors are taking risk anyway. That's kind of the name of the game. No risk, no reward a lot of times. So I completely understand that. And certainly if I were doing investment property on a short-term deal like that, I might consider an adjustable rate mortgage. But for my long-term family household, I'm going with the fixed rate so that my family is locked in and we know what our expenses are. I hope that helps you guys out. I think this is great information. I wanted to research this topic and give you all information on it because it seems to be popping up a lot, and I don't want anybody to get caught off guard because I'm always trying to look out for you. If you need any help as a real estate agent learning about this stuff, or as a home buyer or seller, feel free to reach out to us. Our information is always down in the description. We'd love to help you out.